Good afternoon, and welcome to AIABA's AutoTalk. I'm your host, Rachel Soleimani. Before I introduce today's presenters, a few quick reminders. Everyone that has registered for today's program will receive a copy of the recording by the end of this week. And if you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar. Now, join me in welcoming back our friends from Moss Adams, Amy Stillwell, Senior Tax Manager, and Dan Cheney, National Practice Leader. Guys, take it away.
Thank you, Rachel. And actually, I have an update to Amy's title. Amy is now a tax partner at Moss Adams. Congratulations, Amy.
Congratulations.
Yeah, thanks.
And Amy is a tax partner in our sunny San Diego office, and I'm a tax partner in our rainy Seattle office. So we have that going for us. So Amy, maybe next slide real quick. We'll go over the agenda for today. And our goal really is to get everybody up to speed on recent developments and kind of the most significant issues specific to auto dealers that we think will impact you. We're going to end with the top 10 takeaways. I don't think there's 10, but top 10 talking points that you might want to sit down and talk with your CPA about after going over the presentation. There's significant issues for 2018 that we need to pay attention to. If you've already filed your return, there's still maybe opportunities to fix things before the September 15th deadline, and then there's just a lot of planning that needs to be happening, and so spending time with your CPA should be on the agenda for 2018 and 2019. So we'll go over the pass-through deduction, some of the new interest limitations. We're going to talk a little bit about things that you can't deduct that you used to be able to deduct, and some of these things I think people aren't as aware of or paying close attention to. We'll briefly talk about the opportunity zone rules and a little bit about estate planning opportunities, and then kind of what's currently happening and what still hasn't happened as far as regulatory guidance. And then a quick update on some of the developments in the reinsurance, extended warranty, service contract type of entity issues that are popping up. So we'll start with the pass-through deduction.
So yeah, I'm going to talk quickly about the pass-through deduction. I think this is probably the biggest opportunity for dealers going into 2018. So there's a 20% deduction that's available to S-Corps, LLCs, sole proprietors, not to C corporations, but to pass-through entities only. And basically, there's a 20% deduction, but it's not that simple. There's a lot of rules and regulations that go into achieving that 20% deduction. So just from a really high level, let's say your taxable income is $1 million, you would only be taxed on $800,000 of that taxable income if you could maximize your 20% deduction. So we're going to talk a little bit about how that's calculated in the next slide. So we're going to start on the left-hand side, and we're looking at what is a qualified business. So to first look at whether or not you qualify for the deduction, you must be a trader business. Obviously, most dealers are a trader business, but service employees are excluded from being a qualified business. So once we meet that test, which again, most dealers do, we move to the next test, which is qualified business income. So it has to be U.S. trader business income. So if you have an offshore reinsurance company, it wouldn't qualify for the 20% deduction. So once we get through that loop, we go to the third one, which is W-2 and property limitations. I've kind of noted here that most dealers always qualify. What I mean by that is if you have a store that has a lot of wages, usually you can get to the qualification to have enough wages to get the deduction. So using my previous example, if you had $1 million of taxable income and you wanted to maximize the 20% deduction, you would need to get to your $200,000 deduction, you would need $400,000 in wages. The cool thing here is that you can actually use the wages from your store to make sure your real estate qualifies for the 20% deduction as well. But there are some things we have to do in order to make sure that happens. So I'll talk a little bit about that in the next slide. So the last loop that we have to make sure we meet is a taxable income limitation. So if you potentially had very low taxable income or, in a situation where you were actually in a taxable loss, you wouldn't get to fully utilize the deduction. So you just need to make sure that your deduction can't exceed 20% of your taxable income.
Hey, Amy, just
So,
one comment on that
sure.
prior slide. The service employee, I just want to make sure people know that that's not service department employees. We're talking about businesses like accounting firms or law firms or doctors. There's kind of specified services that are not allowed to take the 20% deduction, but the service department is part of a retail business and we think very clearly qualifies for the deduction.
Right. That does not include the service department. The whole entire dealership, regardless of what part of the store it is, would qualify. So what does that really mean for dealers? It just means that we need to make sure that we're combining the store wages that maybe we can use to get the full real estate deduction on your tax return. In order to do that, you have to do that on your individual tax return, and there's actually what we call an aggregation that needs to be done, and it can only be done in 2018. So if you haven't filed your returns, make sure that your CPA is maximizing your 20% deduction by combining the wages from your store with the real estate entity. So you have to do it on your 18 return. You can do it on an amended 18 return if your CPA by chance missed it. But once you've either made that election or not made that election going forward, you can't go back and change it. So just make sure your 18 return is maximizing that deduction. In addition, one thing that we've kind of looked at for 2018 with this new deduction is owner compensation. So sometimes owners have a really large W-2 through an S corporation, and maybe that wage really is above and beyond what the IRS would consider reasonable compensation. And we can actually reduce that W-2 wage and increase the taxable income that we then use against the 20% deduction. So basically, sometimes when wages are, a little higher than they need to be, we reduce the W-2 and instead pay that owner a distribution to make sure we're getting that 20% deduction. And also, in order to combine the wages from your store with the real estate, you have to have what we call common control, which means the same group of people have to own 50% or more. So just taking a look at whether or not you meet that 50% threshold to make sure that you're maximizing your 20% deduction. Anything else you want to add there, Dan?
Yeah, I was just going to mention that, when we think about that deduction and how people are compensated, one thing that I see from time to time is where you have an S corp where there's maybe 50-50 ownership, but one of the owners does a lot more work than the other owner, and so they end up making up for the kind of difference in commitment to the business in compensation. And so this is an opportunity where you can look at entity structuring as well and think about, does it make more sense to have maybe an LLC where you can have a profits interest allocation instead of making it up in overpaid wages that are taxed in a bad way? So I think that's something to be thinking about. And the other thing I think you mentioned already, but just paying attention to the 1099s that you're getting, over remits from the warranty companies and things like that, how you direct those funds can have an impact on whether they qualify for a 20% deduction or not.
Can you expand on that a little bit? I didn't touch on that.
Yeah, so the 1099 that you get from your reinsurance company is often, self-employment income that comes on a 1099 as non-employee wages, which is akin to compensation, but is it really compensation? And for example, if the over remits were directed instead to the S corp dealership, would it give you a better result? Qualifying for the 20% deduction as being just kind of the overall profit of the dealership, because that's really what it is. It's just taking cost of sales and redirecting them to the individual. And so, maximizing the deduction there, I think, is an opportunity.
Right. So really looking at your 1099 and saying, is this for over remits that we can then redirect to make sure we get our 20%, or is it for something else?
Exactly.
So let's talk about interest.
So interest is the big thing. This is what everybody's talking about. The dealer industry, NADA, and several accounting firms and other players in the industry were able to get the IRS Congress to include a carve out for floor plan interest And this is an area where we don't have a lot of clarity in the law. But floor plan interest is effectively unlimited deductibility if you're not taking bonus depreciation. And so what I think is important for people to know is that is what's the definition of floor plan interest. You know, it's the financing of vehicles for use on the roadway. It's not financing in the form of a cap loan, probably. It's not your real estate loans, and so there's still interest limitations that apply. And the interest limitation, this is one of the kind of give backs. So now you can only deduct interest based on about 30% of your earnings before interest, depreciation, amortization, and taxes. So it's basically EBITDA, but it's tax EBITDA, and that's the limit on interest. Except for you can take floor plan interest above it. And the big question is, you know, what happens with bonus depreciation? Because there's an if statement in the law that says if you don't take advantage of floor plan interest, maybe you can still take bonus depreciation. And the proposed regs came out earlier in the year, I guess last year, that didn't really address what that if statement meant. And then the Joint Committee of Taxation every year, or every time there's a new law, they do kind of a look back at the law, and they write what they call the Blue Book, which explains what they think, you know, this committee of Congress thinks, and it's obviously joint committee, so it's Senate and House, that was meant by the law. And in that document, they said that if you limit the interest, you can still take bonus depreciation if you're an auto dealer. Unfortunately, that doesn't carry the same level of authority as regulations, and the final regulations have not been issued yet. And in our conversations with kind of Treasury, it sounds like they're not going to be issued before the September 15th deadline. And so I guess you have planning around, you know, what to do with this current situation where we have unclear law, but there is an ability to take bonus depreciation potentially, and floor plan while limiting your floor plan. And I think it's just one of those things that you need to proceed cautiously and determine what approach you're going to take and what you're comfortable doing on your 2018 return. For your 2019 return, we'll probably have a lot better clarity on this issue.
I have a question, Dan, real quick. It says,
Yeah.
Should floor plan assistance not be netted against floor plan interest when determining the limitation? Should floor plan assistance?
So, I mean, that's something that each person needs to consult with their tax advisor. Our sense is that for floor plan interest, the credits, for those of you that are familiar with the accounting methods that are available to the kind of auto industry, the credits are considered a trade discount. So it's really not considered a floor plan financing item. It's considered a discount in the purchase price of the vehicle, and probably is appropriately treated as a component of cost of goods sold, not as a component of interest. So I guess my sense is that's a little bit aggressive to try and net those against interest, just because of the nature of the benefits we're getting on that very same issue on the other side. But again, these are things that there's no black and white answer. They're definitely in the gray.
Right.
I don't know, Amy, if you have a different thought there.
No, I think we don't have guidance, and so it's up to you and your CPA sort of what position you're going to take. I think that you could really go either way with this. If you wanted to take your floor plan interest and treat it just as regular interest and limit it to 30% and take bonus, I think that you could potentially do that, or potentially you treat it as floor plan interest, get to deduct the whole thing and don't take bonus. I think you really can go either way at this point, but I think that's between you and your CPA to determine. One other thing I wanted to mention really quick, Dan, too, is the store real estate, the interest that you're paying on your mortgage loans is also subject to this limitation. And we have seen a lot of our clients have an interest limitation on the real estate that we hadn't potentially anticipated before. So it's really important to take a look at your debt financing, which I think we'll get into in a minute.
Yeah, no, I think that's a really good point. And I think that's kind of the perfect segue into looking forward, because one of the things that we think about is if you give bonus depreciation, for example, in your real estate entity, right now, when we calculate this interest limitation, we're able to add back depreciation and amortization, but that goes away in 2022. And so your ability to take that interest is restricted by basically taxable income. And so you're going to get less interest in the future. And I guess one thought is that if you are going to do a cost seg, it's probably now's the time. And a cost seg is where you're accelerated the depreciation on your buildings by doing an engineering study to look for carving out specific costs, kind of to the nature of a dealership. But if you do a cost seg now and get 100% bonus depreciation on the real estate, it gets added back for that interest limitation. In a few years, it won't, and that will maybe give you a different result. The other thing to think about is, this interest limitation currently, based on what we have, it's at an entity level. And so if you have one entity that has kind of lower income and higher leverage, you might want to start thinking about where do you place debt? And if you have a collection of entities, there might be an opportunity to restructure debt to have a better result there.
Yeah. I mean, we've definitely looked at that for a lot of our clients. So something to think about.
One more thought is just a couple of things that they don't have guidance on. We don't have guidance on, kind of the self-charged interest scenario where you have, you're loaning money to your own entity, or on kind of these tiered entity structures where it's an upper tier and a lower tier. Both those scenarios are reserved in the proposed regulations on interest, and we don't have final regs. So that's kind of an area where, once again, we're in the gray and trying to use our judgment to figure out, what's the right thing to do there.
So let's talk about items that are no longer deductible, or I should probably say partially deductible. Probably a lot of you have heard, but entertainment, unfortunately, is no longer deductible. So things like golfing, sporting events, shows, those are no longer deductible, regardless of where they are personally or in your business. Something that came out recently is the IRS said, well, we'll let you take a deduction of 50% for meals at entertainment events as long as it's a separate invoice. So if you're going to be getting a box or something that's a very expensive item, you should request a separate invoice for meals, because you can get 50% for that. Meals on the premises for your employees used to be 100%. Now it's 50%, just something to be aware of. An issue that is new for 2018 is parking, and parking for employees. So if you pay to have a lot across the street from your store, you rent that for employees to park in, you can no longer write that off, which is crazy to me. So just be aware of that. And then there's also rules, and they're actually very complicated, believe it or not, around employees parking on site if you have reserved parking on site, or you have spots that are not available to the public, which I think most people have. The IRS has a formula for the piece that is not deductible. So what we've been recommending for people is that if they have reserved spots they're not actually using, to take the signage down to ensure that they can get that piece of their rent deduction, which is crazy. And this has, the parking rules also apply to not-for-profits. So it's crazy to me how all of a sudden a lot of charity organizations have taxable income because they also have to compute this parking limitation, which is absolutely insane to me. But the most knowledgeable person in our office is a not-for-profit when it comes to parking. So anything to add there, Dan?
No, I think you're right on. I think the parking is one of those left field things that caught a lot of people off guard when the law was finally in place and started seeing what that really meant. It's not great news.
Okay. Next thing we're going to talk about is qualified opportunity zones. This is very much front and center for a lot of people in 2018. A lot of promoters are out there pushing qualified opportunity zones. A lot of promoters are looking for people to invest in them. And basically what it is, and some people say it's akin to a 1031, but really it's any kind of capital gain you can invest either in a piece of property personally in an opportunity zone or through a fund. And basically what it is they're looking for people to buy land in sort of areas that need to be built up, sort of low income areas, to be quite frank. And my personal opinion on qualified opportunity zones is they are a great tool for you if you have a capital gain and you're looking for a place to invest your money, but you have no need to access it within the next 10 years. So basically what you have to do is you have to either invest in a fund or buy a piece of property, and you have to be okay with not touching the cash for 10 years, or at least the initial investment of the cash for at least 10 years. And so there's a lot of hoops. There's a lot of IRS rules surrounding these. And so it's pretty hard to meet all the qualifications. And then with a fund, when you're investing in a fund, you obviously don't have control over your money. It's like investing in a publicly traded partnership. So just things to think about. From my personal perspective, if you're looking for a place to park your cash and you're okay with not touching it, great. If you are going to potentially need the money in the next 10 years, not so great. Anything you want to add on that, Dan?
No, I think that was very well said, and just not so great. Just a quick update on estate planning. The exemption went up to $11.4 million per person, and that's scheduled to go back to $5 million in 2026. So that's in, your lifetime exemption. And I think the point here is that one of the things that's different about this time is that you have no clawback is specifically called out. So if somebody were to give, $11.5 million or $11.4 million to their family through the appropriate type of vehicle, something where you can still enjoy the income, and give assets that are going to grow in value, the leveraged assets. Now's the time to do that. I mean, it's if we do it now and then it goes back to $5 million in 2026, that gift is already out of your estate, and we don't have exposure anymore to that issue. So I don't know how long this is going to hang around, but I think it's something that we all need to pay attention to. And the other thing to pay a lot of attention to is, a lot of states have state estate taxes, but not state gift taxes. So you can give the money before you die and not have exposure to the estate tax, and not have a tax on the gift now. So this is just something that we're also focused on everything that's happening on the income side of things, but the estate side of things is a huge deal, and there's a lot of opportunity there. And no matter the size of your estate, it should be something that's being discussed. And then one more comment is just where are the rules? There was proposed regulations issued related to these non-controlled foreign corps. For those that aren't familiar, those are the pooled reinsurance arrangements. A lot of people have them where they have a less than 10% ownership of a foreign entity, and they set up a pooled reinsurance arrangement, and it's not taxed in the U.S. Well, new guidance came out that makes it look like those types of arrangements could be a passive foreign investment company, and there's a lot of planning that's been done around that. The new regs were not friendly. We don't know what's going to happen, kind of the conclusion of that, because they are proposed and we don't have final regs. And they came out after the June 22nd date that regulations need to be published to have retroactive effect. But for 2019, that's going to be a big issue to pay attention to. And kind of another development on that front is that there's new economic substance regulations being issued in these foreign jurisdictions. The European Union has required a number of foreign kind of tax haven countries to set up economic substance regulations in those countries, because they were basically, there was no economic substance. They were just tax avoidance structures that the European Union was having an issue with. And so they blacklisted a number of countries and said, if you don't put regulations in place to make real substance to these international entities, we won't let you transact with the European Union. And so that's created additional pressure that a lot of people aren't aware of on these foreign entities, having to, actually have employees in country and having meetings in country and things like that. So that's something you might hear a little bit more if you own one of these entities about. And then just a couple of other thoughts. We still are waiting on final regs on both bonus depreciation and the interest limitation under 199 or 163J. So those two limitation are benefit items. We've had direct conversations ourselves with senior people at the Treasury, and what we're hearing is that nothing's going to be published before the September 15th deadline. So the law as it stands today is kind of what we're going with. But it is definitely a different year than most tax years, and like we said, consult with your advisor. The only other thing on the non-controlled foreign corps real quick before we wrap up on that is that there is a statement that needs to be put on your 2018 return for most of these arrangements that basically allows you to protect kind of the capital gains nature of liquidating the entity. And it's called a qualified electing fund. It's a statement, not an election, but if you own one of these arrangements and you don't have a statement on your 2018 return, you need to change that. It probably needs to be there, and you need to talk to your tax advisor about it. And finally, Amy and I wanted to give you guys just kind of a list of things that you would talk to your CPA about or think about, plan around. And so this is kind of the most significant issues we think that should be paid attention to. I don't know, Amy, if you wanted to make any comment on these.
Yeah, no, I just think reviewing your entity structuring, reviewing your debt financing, looking at whether or not you want to do a cost save or do a factory refresh, all of those are things that you need to look at in the near term, if not 2019, 2020. Just make sure that you're maximizing that 20% deduction. I have seen a lot of tax returns where CPAs unfortunately haven't combined store and real estate items to maximize that deduction. And just make sure that you're not getting limited on your interest on your real estate because your debt is structured potentially inaccurately for the new law. And then again, we talked about it a lot, but just making sure that you're spending on capital expenditures if it makes sense for you business-wise before 2022.
And the other thing that is kind of always surprising to me, the comment earlier about, or the question about floor plan assistance is how many people out there are not taking advantage of just the fundamental accounting methods for auto dealers that significantly reduce your taxable income. And so it's always good to get a checkup on your accounting methods and make sure that you're doing all of the beneficial methods that you can do, and that you're kind of planning that deferral, because right now we're in a low rate environment and we have these tax deferrals, and making sure that you're looking out into the future and thinking about in future tax rate environment, and when do you want to trigger deferrals, when do you want to create bigger deferrals, and just managing kind of that wave of deferred tax that at some point could come crashing in, and protecting yourself from bad timing on that.
Yeah, just one point on that. When Dan says accounting methods, a lot of those accounting methods are tax-only accounting methods. So you wouldn't have to actually book them on your dealer financial statement or affect pay plans. A lot of them we can just do for tax purposes. So definitely maybe check in with your CPA and make sure that you're taking advantage of all the accounting methods that are available to dealers, because there are a lot. So I think that's the end of that. I know that the reinsurance and CFC issue is really complex. So here's our contact information. If you want to contact Dan on that, not me, but Dan, because sometimes I feel like that's just an issue that's super complex and not a lot of people understand it. And I don't know that I fully understand it because it's not my niche. Do we have any questions?
Yeah, there's a few questions that came in. One of the questions was just, does it make sense to do cost segregation studies on new construction projects? Does it still make sense given the environment? I don't know if you want to take that, Amy.
I think they do, right? tax reform is not prohibitive to cost segregation studies. Obviously, you're reducing your taxable income, but you have an interest add back for that, and that maybe isn't really a clear answer. But I think in terms of maximizing the law, I have seen plenty of our clients do a cost segregation study, and it's always been beneficial for them.
And if anything, it's better to do it now, right?
Yeah, no, because you lose the interest add back after 2022. So it really does make sense to do it now or next year or the year after that, but just sort of plan before 2022, because then you're really probably not going to benefit because you'll have an interest limitation.
Yep. I see another question. Can you re-explain why reinsurance companies would not be subject to the 20% deduction? And I'll start by saying it depends on what income you're talking about from the reinsurance company. The dividends that come from it, it's a C Corp. They're all C Corps. So the 20% deduction is on pass-throughs, so that would be one reason why you wouldn't get the 20% deduction. On the over-remits, the question is whether or not you get the 20% deduction on the over-remits, and the issue being that wages are not eligible for the 20% deduction. Service-based income, like basically guaranteed payments from a partnership, for example, or a 1099 self-employment income type of item may or may not qualify for the 20% deduction. So that's where there's a little bit of gray, and to maximize your opportunity to get, basically, could there be an argument that 1099 from the reinsurance company is akin to wages? How about we just have that 1099 go to the dealership? Then there's really no question that it's just part of the profitability of the dealership. Not saying you can't get there either way, but the over-remits would be the area where planning is probably a good idea.
Right. So just to be clear on that, the 20% deduction is not available to C corporations. And most
Correct.
Reinsurance companies are C corporations. So that was why I alluded to that earlier.
And we have, I don't know if we have time for maybe one more question, Rachel. We've gone over, I think, our time a little bit. But
sure, go ahead. You're good, go ahead.
Okay, one more question is just kind of a perfect segue is on the C Corp side of things. Why not C Corp now? You've got this 20% deduction for pass-throughs, but do C Corps make better sense? And I don't know, Amy, if you want to jump on that? Or...
Yeah, no, I'll start. Maybe you can finish. If you just have a regular standalone dealership, it doesn't make sense. And the reason why is because C corporations, you're taxed on the money when you earn it, and then you're taxed again when you take it out of the company. So unless you intend on having a C corporation where you never take out any cash, and I have never known a dealer to not take out cash, or you intend on selling your stock, those two things have to happen in order to sort of maximize a C corporation. And I think, as everybody knows, dealerships do not sell stock, they usually sell assets. So from a traditional dealer sense, C corporations don't make sense because of the double tax. And you want to just tack on to that, Dan. Go ahead.
Yeah, no, and I think you nailed it. We've done it a lot. We've done a lot of modeling for a lot of our clients, just trying to see if there's a way that it would make sense. And obviously, you'd want to look at your specific scenario. But even with Amy in the high tax state of California, our models have shown that 99% of the time, if you're taking cash out of the company, which is kind of why we own these things, it doesn't make sense to be a C corp. There may be a scenario where it could, but I agree. We don't see it very often, even with the additional 21% rate.
Yeah, not for dealerships. I don't think. I mean, other industries maybe, but not for ours.
Oh. Awesome. I think that's good for us, unless there's any other questions.
I think we're good. Dan and Amy, look at those beautiful headshots. Love it, love it. Love you guys. We love having Moss Adams as an affinity partner. Just a really great company full of really great people that are easy to work with. So thanks again for taking time out of your busy schedules to update us on this important topic. To keep our AutoTalk series going, join us on September 17th at 2 p.m. Eastern as Jonathan Smoke, Cox Automotive's chief economist, talks to us about auto market trends and outlooks. And in October, Aaron Kerrigan of Kerrigan Advisors will discuss the buy-sell market in 2020. So be on the lookout for promotions on how to register for both. For more information about AIADA, visit AIADA.org or call 1-800-GO-AIADA. As a reminder, you all will be receiving a copy of this webinar by the end of this week. Thanks for joining us and have a great day, everyone.